Welcome everyone to our comprehensive guide to invoice financing. Today, we'll delve into how invoice financing works, explore its benefits, discuss key considerations, and review the required documents to get started. Our goal is to provide you with a thorough understanding of this financing option and how it can support your business's cash flow needs. Let's begin by understanding the fundamentals of how invoice financing works. First, your business provides goods or services to your customers and issues invoices for payment. These invoices represent your accounts receivable. Next, you apply for invoice financing with a third-party financing company, also known as a factor. The application process typically involves submitting detailed information about your business, your customers, and the outstanding invoices you wish to finance. Once your application is submitted, the factor evaluates the creditworthiness of your customers and the quality of the invoices. They assess various factors, including your customers' credit histories, the aging of the invoices, and the likelihood of payment. If your application is approved, the factor advances a percentage of the total invoice value, usually ranging from 70 to 90%. The exact advance rate depends on factors such as your customer's creditworthiness and the industry in which you operate. Now let's look at the financial aspects of invoice financing. The factor charges a discount fee for their services, which is deducted from the remaining value of the invoices. This fee is typically calculated as a percentage of the total invoice value and can vary based on customer creditworthiness and the risk associated with the invoices. After advancing funds, the factor takes over the responsibility of collecting payments from your customers. This means when your customers pay the invoices, they make payments directly to the factor. Once the factor receives payment from your customers, they deduct their fees and the amount advanced from the total collected. The remaining balance, known as the reserve, is then returned to your business. This process not only improves your cash flow, but also transfers the burden of collections to the factor, allowing you to focus on running your business. Now let's discuss the benefits of invoice financing. One of the primary advantages is improved cash flow. By converting accounts receivable into cash, invoice financing provides immediate liquidity. This can help your business cover operating expenses, pay suppliers, invest in growth opportunities, and manage cash flow fluctuations more effectively. Another significant benefit is quick access to funds. Compared to traditional loans or lines of credit, invoice financing offers a much faster turnaround. Businesses can often receive funding within days of applying, making it an excellent option for addressing urgent financing needs. Additionally, invoice financing is a flexible form of financing that grows with your business's sales volume. As your business generates more invoices, you can access more financing, providing scalability to meet your changing funding needs. This makes it an ideal solution for businesses experiencing rapid growth or seasonal fluctuations. Another key benefit of invoice financing is that it typically does not require collateral. Since the factor assumes the risk of non-payment by your customers, there is no need for your business to provide additional collateral to secure the funding. This is particularly advantageous for businesses that may not have substantial assets to pledge. Invoice financing also offers the advantage of outsourced collections. The factor handles the collections process, relieving your business of the administrative burden and time-consuming task of chasing down payments from customers. This allows you to focus on core business activities and growth strategies. While there are many benefits to invoice financing, it's important to consider the costs involved. Invoice financing fees can be higher compared to traditional forms of financing such as bank loans or lines of credit. When evaluating invoice financing options, businesses should carefully consider the total cost of financing, including the discount fees and other charges. Another consideration is the potential impact on customer relationships. Some businesses may be concerned about how invoice financing could affect their relationships with customers. However, most invoice financing arrangements are confidential, meaning that customers are not notified of the financing arrangement. This can help maintain the integrity of customer relationships. It's also essential to evaluate the creditworthiness of your customers, as this will affect the advance rate and discount fees you receive. Businesses with customers who have poor credit may face lower advance rates or higher discount fees. Therefore, it's important to ensure that your customer base has a good credit history to maximize the benefit of invoice financing. Carefully review the contractual terms of the invoice financing agreement before entering into a financing arrangement. This includes understanding the advance rate, discount fees, recourse or non-recourse terms, and any other contractual provisions. Additionally, be aware of any minimum volume requirements or minimum fees that the factor may impose. To apply for invoice financing, you will need to provide several key documents. An invoice aging report is crucial as it provides details about your outstanding invoices, including the invoice number, invoice date, due date, amount, and aging, number of days outstanding. This helps the lender understand your accounts receivable turnover and the aging of your outstanding invoices. Additionally, you'll need to provide copies of the invoices you wish to finance. Each invoice should include detailed information about the products or services provided, the payment terms, and the customer's contact information. Include customer credit information such as their credit worthiness, payment history, and any credit checks or evaluations you've conducted. This helps the lender assess the risk associated with financing your invoices. Some lenders may also require proof that the products or services covered by the invoices have been delivered or completed satisfactorily. This can include delivery receipts, signed work orders, or other documentation. Provide your business's financial statements including balance sheets, income statements, and cash flow statements. These statements help the lender assess your business's overall financial health and ability to repay the financing. Additionally, provide documentation that establishes your business's legal structure and ownership, such as articles of incorporation or organization. If applicable, include copies of contracts or agreements with your customers that outline the terms of the sale or service provision, including payment terms. Lenders may also request identification documents for business owners or guarantors, as well as any personal guarantees required. Recent bank statements may be needed to verify your business's cash flow and financial stability. Lastly, provide personal and business tax returns for the past few years to demonstrate your income, financial history, and tax obligations. Thank you for your attention throughout this presentation. If you have any questions or need more information on today's topic, please